Welcome to the Advisory Group's Economic and Market Update and Year-End Proactive Tax Planning for 2025 workshop. Let's first start with some introductions. My name is Mark Cox. I'm a Client Services Associate as one of the TAG team members. Also joining me are Brent Beverly, the President of the Advisory Group, Chris Lee, the Vice President of the Advisory Group, and Manny, a Senior Advisor at the Advisory Group. All three of them are certified financial planner practitioners and wealth advisors at our Diamond Bar branch. Also speaking will be Will Glenn, another Client Services Associate with our TAG team. So at our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can help them make an informed decision. Our belief is that the more you know, the more you will appreciate how we help you. So, our agenda is very straightforward. First, we will share with you a brief economic and market update. Then, we will discuss some proactive tax planning for 2025, especially after the passage of the One Big Beautiful Bill Act. And as a reminder, it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. We will be covering aspects of all of these in today's workshop. So, to get us started on the core of our workshop, let me bring on our first speaker, Manny. Manny?
Thank you, Mark. 2025 has brought some interesting dynamics for investors. We have seen significant market fluctuations and volatility. As the new administration took office, we have witnessed substantial changes, including tax law changes, political unrest and fighting, interest rate movements, and the imposition of new tariffs and sticky inflation. So how have equity markets performed with all of these forces at work? As the chart on your screen shows, year to date, the broad-based S&P 500 index, despite everything, including a very brief bear market in April, is currently up from the beginning of the year. With the equity markets reaching new highs in September, it's easy to forget that the first half of this year was one of the most volatile first halves ever, with the equity market experiencing a correction of nearly 20% before rebounding to reach new highs. Recently, the equity markets have been fairly consistent despite that challenging environment. So while many factors continue to affect the movement of equity markets, some major equity market concerns we monitor include the direction of inflation rates, interest rate changes, and geopolitical unrest. Inflation is still a very big concern. Many dreaded the fact that inflation would come back with a vengeance due to tariffs. While slightly higher, inflation has not seen a sharp incline. In August, the PCE inflation rate in the US stayed at 2.9%. Inflation remains a concern, but the current numbers are not alarming. As for interest rates, the Federal Reserve's benchmark interest rate was a stagnant range of 4.25% to 4.5%. The first part of the year until the recent September FOMC meeting, rates were lowered by 0.25% down to a range of 4 to 4.25%. During this meeting, it was also indicated that there could possibly be 1 or 2 more cuts this year. Stocks initially moved higher with this news. Now, the Fed has said that they reduced rates due to the need to support a weakening job market. Some analysts are calling for additional rate cuts next year, but we will need to see if that happens. The global economy is still in a very vulnerable position. Currently, the political atmosphere has been tense, to say the least. There is still an ongoing struggle in the Middle East. There is the Russia-Ukraine conflict still unsolved, not to mention the situations involving China and Taiwan in the South China Sea. Also, the uncertainty surrounding tariffs and trade brings uncertainty, and equity markets do not like that uncertainty. Having said that, so far, the equity markets have moved upwards, but we will keep an eye on how these issues may affect the markets moving forward. As financial professionals, we try to provide proactive long-term planning for clients. So while no one has a crystal ball that works and past results do not reflect future returns, we find it interesting to know that based on historical data for the S&P 500 index, the fourth quarter has been the strongest performing quarter for equities. Since 1950, it has delivered the highest average return and the highest probability of posting a gain. Seasonal factors like holiday spending, corporate earnings releases, year-end capital inflows, and portfolio rebalancing contribute to the strength. Now, this chart on your screen reflects average returns since 1950. Please be sure to know this includes several very difficult fourth quarters, including October of 1987 when the market collapsed and had its worst single day in history. So when studying the returns, 80% of the time, the fourth quarter ended the year on a high note. As we head into the end of the year, we continue to keep a very watchful eye on equity markets. So what is our strategy moving forward? When it comes to equities, our advice is that long-term investing is a prudent strategy to adopt. So let's take a look at long-term equity returns. As the chart here on your screen shows, investors who focus on a long-term strategy were historically rewarded with significant returns. While ups and downs are part of the investment experience, the 40, 30, 20, and even 10-year investment timeframes have seen equities advance. Now, the past does not predict the future, but we believe that this trend will continue. Now, we would like to remind you of these 4 things that can help us approach your investments with discipline and focused direction. Your risk tolerance or appetite. By this, we mean how much risk can you take, or better yet, how much can you afford to take? Your time horizon, or the amount of time you want to be invested in any situation, which can help you determine your entry and exit points. Your behavior. Market volatility is a part of the investment experience. This can create anxiety and stress when volatility occurs. Do you know how well you can emotionally endure the potential ups and downs of your investments? And your overall strategy. Are you looking at something that doesn't quite fit with your overall strategy? Perhaps the media is influencing you to make a rash or impulsive decision on your investments. We want your holdings to be congruent with your overall strategy. Panic can create more risk and potentially cause setbacks in your goals. Our main goal is to stay focused on your overall strategy. Now, this might be an ideal time to remember these words of wisdom from the legendary Warren Buffett. We don't have to be smarter than the rest. We have to be more disciplined than the rest. And with that pearl of wisdom, allow me to bring up our next speaker, Brent Beverly. Brent?
Well, thank you, Manny. So as I'm sure all of us are already aware, the One Big Beautiful Bill, the OBBB Act, was signed into law on July 4th. Now, this massive bill incorporates a wide range of tax and spending policies aimed at providing relief for taxpayers and boosting economic growth. This bill made permanent many of the individual tax cuts and reforms of the 2017 Tax Cuts and Jobs Act, or TCJA, we'll refer to it by both here, the TCJA, that were set to expire at the end of this year. So it kept those cuts and left them going. So while there were a lot of provisions packed into this act, we want to focus on some of the key items we feel apply to a large group of our investors and savers. The Tax Cut and Jobs Act, TCJA, income tax brackets were scheduled to sunset at the end of this year, 2025. These brackets are now extended and made permanent, saving millions of taxpayers from a tax increase. Now, as a quick note here, when we say permanent, what we really mean is that it takes another act of Congress to change them. Unlike the rates in the TCJA, where the tax rates were set to expire at a certain date, the new provisions have no end dates. So permanent does not necessarily mean permanent, but it does mean it takes an extra act to make them change. Now, there was also a slight upward adjustment in the top 10% and 12% brackets, thereby granting a small amount of additional relief starting in 2026. Now, this is a sigh of relief for taxpayers that could have seen much higher tax brackets, including the pre-TCJA highest tax bracket of 39.6%. Okay, top bracket now stays at 37. So nice help. Now the TCJA nearly doubled the standard deductions while eliminating personal exemptions. The OBBBA, the new tax bill, made this higher standard deduction permanent and also provided a slight increase. So starting this year in 2025, the deduction will be $15,750 for single filers, that easy for me to say, $23,625 for heads of household, and up to $31,500 for married couples filing jointly. There's a new deduction for taxpayers who are age 65 before the end of this tax year. From 2025 to 2028, qualifying individuals can deduct up to an additional $6,000 off their taxes. So notice that termination date. This is not permanent. The deduction phases out for incomes above $75,000 for singles and $150,000 for joint. The deduction phases out over the next $100,000 in taxable income, so it's completely phased out for singles at $175,000 and at $250,000 for couples filing jointly. Now, this deduction was meant to partially fulfill the president's campaign promise to eliminate taxation of Social Security benefits. However, Social Security benefits are not required to qualify for this deduction. It applies to anyone over age 65 and over. Also starting in 2025, the state and local tax deduction, SALT, is raised from $10,000 to $40,000, the limit on that, with a 1% increase in the cap year through 2029 before returning to the $10,000 limit for 2030. So again, not a permanent change. This $40,000 deduction cap is phased down to the prior $10,000 cap for taxpayers with a modified adjusted gross income, MAGI, okay, a modified adjusted gross income of over $500,000, $500,000. The phase down occurs over a $100,000 range from $500,000 to $600,000. And therefore, taxpayers with an MAGI of $600,000 or more are limited to a SALT deduction of $10,000, same as it was before. The OBBB also includes a so-called new Trump account. The plan actually has that in there as a Trump account. Now, this is a tax-advantaged investment account that is pre-funded with $1,000 for each child born from the beginning of 2025 through the end of 2028. Again, not a permanent change. Children born during this time are eligible for this IRA-like account option, but not necessarily the $1,000 initial deposit. The goal of this new account is to encourage an early start on saving and investing early in life so that these children have a better opportunity to accrue savings by the time they're ready for larger life expenses, such as college or the purchase of a home. While the Trump account has good intentions, it is rather complex and comes with a gamut of parameters that dull the attractiveness of the $1,000 throw-in. And the government's still trying to figure out how this is going to work. This account will not be available until the earliest mid-2026 next year. And please remember, there are many other alternatives for savings for children, such as a 529 plan that may have greater tax advantages and allow the addition of additional funds. There are also new provisions in the OBB, the new tax plan, that provide tax deductions for tips and overtime pay. Now, these deductions are, again, not permanent. They're available from 2025 through 2028. Now, the deduction for tips received is up to $25,000. However, very complicated, there are a number of qualifications, including that the tips must be received in an occupation that customarily and regularly receives tips, such as waitressing and things like that. Now, individuals who receive overtime pay that is required only by the Fair Labor Standards Act, the FLSA, that exceeds their regular pay are also entitled to a new deduction. And this deduction is capped at $12,500 for single or $25,000 for joint filers. Both of these provisions are phased out for earners making over $150,000 single or $300,000 filing jointly. There are some other notable changes that we want to mention. The first one is the child tax credit has increased by $200 and is now $2,200 per child, effective in 2025. This credit is reduced or phases out for single filers with incomes over $200,000 and for over $400,000 if you're filing jointly. Now, the TCJA back in 2017 reduced the loan principal, which could incur deductible interest from $1 million to $750,000. The TCJA also eliminated the deductibility of mortgage interest not attributable to acquisition indebtedness. Now, the new bill made these provisions permanent. However, it does restore the deductibility of mortgage insurance premiums. So get some, give some. There's a temporary provision that allows the deduction of interest on certain loans used to purchase personal vehicles, key thing there, personal vehicles made in the USA. This deduction is effective from 2025 through 2028 and phases out on incomes above $100,000 for single and $200,000 for joint filers. For business people, the Section 199 deduction, 199A deduction, also known as the Qualified Business Income, QBI deduction, or the pass-through deduction, another term we use for it, was enacted as part of the TCJA Act of 2017 to provide a tax break for many owners of small businesses. The new bill made this 20% deduction permanent. Again, giving our qualification of the term permanent here. Now let's shift to proactive tax planning for this year, for 2025. Now, of course, we feel that taking a proactive approach to your tax planning instead of a reactive approach could produce better results. Let me start by quickly distinguishing the difference between tax planning and tax preparation. We do not do tax preparation. Tax planning is looking ahead before the year end, whereas tax preparation is filling out your tax forms after the year end. Everyone's situation is different, and therefore everyone's situation needs to be considered separately. A general way to look as a taxpayer as being one of three categories of federal tax brackets. The first two brackets, the 10 and 12%, are the lowest tax brackets. So actually 0, 10, and 12. The next two, 22 and 24, are the ones where investors should think about calculating the tax impact of decisions. And if you're in that first tax bracket, you may look at alternatives to use up those lower tax brackets up to these levels. For those in the 32, 35, or 37% bracket, we call these taxpayers tax sensitive because these are the high tax brackets. This is where taxes really become important. Our strategy, again, to be proactive, not reactive. So let's look at some actions you may want to take in 2025 and beyond. So to discuss that, let me bring up our next speaker, Chris Lee. Chris?
Thank you, Brent. So how should you view itemized deductions if you have enough deductions to go beyond the standard deduction? The old rule was primarily to try to accelerate or realize deductions and take them as soon as possible. With a higher standard deduction, the new rule is to time or carefully plan your deductions. Bunching deductions into a given year can more effectively use them from a tax perspective. In 2025 and moving forward, long-term capital gains can still receive substantial federal income tax breaks. There are still three tax rates of 0%, 15%, and 20% for long-term capital gains, which are for assets and investments you have held for more than a year. Since capital gains rates are still favorable, as part of a year-end tax planning strategy, it can be helpful for taxpayers to review capital gains and loss harvesting. Harvesting capital losses is a strategy where a taxpayer sells assets that are at a loss to offset capital gains. This is a tax deferral strategy that can be valuable. A key fact to remember is that you can use up to $3,000 in losses above your capital gains to offset ordinary income. The other form of harvesting is harvesting capital gains. Capital gains harvesting means taking capital gains and paying taxes in the current year. Remember, when harvesting long-term capital gains for tax purposes, although the tax is paid at a lower rate, it is paid sooner. Keep in mind that there is a 0% bracket, and this acceleration of gain is advantageous for those who have low-income years. For those who are not fully retired, remember to review your year-end retirement contributions and do planning. Here are some 2025 contribution plan maximums that can be applicable if you're participating in one of these plans. If you have questions about retirement plans and how to maximize your contribution, please contact us. For some people with IRAs that have not been taxed, a partial or a full Roth conversion could be something to consider. Some benefits from a Roth IRA conversion include they could lower your overall taxable income long term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no required minimum distribution. Roth IRAs allow tax-free withdrawals for beneficiaries. Roth IRA conversions are not for everyone, but if you would like to explore this, then please see us or your tax professional. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, or RMD, in the year that you're converting, then you must take your RMD before converting to a Roth IRA. Especially with the new tax rules, doing a Roth conversion may trigger phase-outs of some of the deductions you may have otherwise received. Be sure to work with your financial and tax advisors to determine the amounts that work best for you. Overall, family tax bracket management is a critical area for those with untaxed retirement assets to explore each and every year. One of your choices is always to leave everything the way it is currently. If you're in a higher marginal tax bracket than your beneficiaries, then it might make sense to let them take the distributions after your death in their tax bracket rather than pulling money early in yours. However, if your beneficiaries are in a higher marginal tax bracket, then it might make sense to take distributions in your tax bracket before death and then convert these accounts to Roth IRAs and leave your beneficiaries an account, while it still must be taken in 5 years, can grow completely tax-free. An annual step to consider is to review your marginal tax bracket and that of your beneficiaries each and every year. We discussed the effectiveness of 529 plans earlier. As we noted, college saving plans can also bring tax efficiencies. 529 plans can allow the building of educational funding and tax-free investments. As with any of these tax advantage programs, there are rules that need to be met. If you want to explore tax-efficient ways to save for college, please reach out to us. Let's talk about annual gifting now. You may gift up to $19,000 gift tax-free from each donor to each donee in 2025. This is a $1,000 increase from the $18,000 in 2024. We like to express this as the tax-free gift is $19,000 per year per person per person. In other words, this annual exclusion gift is doubled to $36,000 per recipient for gifts made by married couples. These annual exclusion gifts do not reduce your lifetime gift tax exemption and do not require the filing of an additional gift tax return. You can also help someone with medical or educational expenses without incurring a gift tax. There are opportunities to give unlimited tax-free gifts when you pay the provider of the services directly. The medical expenses must meet the definition of deductible medical expenses. Qualified education expenses are tuition, books, fees, and related expenses, but not room and board. You can find the detailed qualifications in IRS Publication 950 and the instructions for the IRS Form 709 is at www.irs.gov. Qualified charitable distributions, or QCDs, are still a strategy for retirement plans. As part of the Secure Act 2.0, required minimum distributions, or RMDs, were changed to start at age 73 instead of age 72. For anyone born in 1960 or later, the RMD age is changed to age 75. Qualified charitable distributions, or QCDs, are a tax provision that allows retirement savers over age 70 and a half to directly distribute up to $108,000 to eligible charities straight from their retirement accounts and not pay tax on this distribution. One idea that experts suggest is if you are charitably inclined, consider using part or all of your required minimum distribution for a qualified charitable distribution. If you meet the qualifications to utilize this strategy, the funds must come out of your IRA by December 31st, 2025. They must also go directly to an approved charity. If you want to verify that your charity is an approved charity, we have a link on our website, www.tagfinancial.com, and this will enable you to get to the IRS tax-exempt organizations search tool. Like many other strategies we are discussing today, this is an area that needs to be done properly. So please use your tax professional and consult with us about this strategy. To take us to the end of today's presentation, let me bring up Mr. William Glenn.
Thank you, Chris. We trust you found this presentation helpful. Again, we want to emphasize that a proactive approach to your tax planning instead of a reactive approach could produce better results. One of our goals is to keep clients updated when tax laws change so that they can proactively plan. If you'd like to discuss how these sunsetting rules or any tax law changes may affect your situation, please feel free to contact us and we'd be happy to assess your unique financial situation. So, what can you expect from us? One of our main focuses is to review changes for our clients on an ongoing basis. You can expect regular communication and more frequent discussions. Further, you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. In fact, we'll be offering other workshops that highlight tax changes and planning ideas. And remember, we are here for you. If you have any questions or need clarification on any of these matters, please reach out to us. We appreciate your focus during this presentation. We hope you have found this information helpful. We hope we've made these complex concepts a bit more understandable. Please read through these disclosures. If you want to reach out to us, here is our contact information. We're going to post this again in a few minutes at the end of our presentation. We're thankful for the opportunity to assist you with your financial needs. Remember, at our firm, clients come first. Your health and well-being is always our highest priority.